Yeah, I'm much better good looking than you. So
Really?
he was
How much
he had
work
that
do you
joke.
think you're gonna do?
He had that joke before me, so I took it over. So Andy, thank you very much for being here today. We're very honored to have you here and to have the opportunity to have a chat with our friends, partners, customers about the challenges that we see on the digital transformation of banks, essentially. And I have the first question, which will trigger. Don't make any answer, short. Just explain. I don't have many. That's why. Okay. So just explain as much as you want.
Don't worry, I'm never
This is
short.
a fireside chat without fire. So we need to put some fire in it. So the first question is around, the banking industry has undergone or is undergoing a big change, which is, the regular business, which is all the spreads in the interest rates, sooner or later are going to be regulated by the regulators at some point. And that business that used to be more in a place where you can play will be shorter. So that is forcing banks to go ahead and figure out how, to seduce much better your customers or your consumers. So how you see that, evolving, how that is affecting the priorities within HSBC or within the bank community or within whatever?
Nice, simple question.
Yes, to start. I have many others, if you want.
It'll only take me 25 minutes to do this one, so it'll be fine.
Who's your Uber? No, I'll change it.
So look, I think basically revenue growth for banking has been dead for about 5 years, and I don't think it's going to come back anytime soon. You were talking about spreads. That's because you're from Latin America. For the rest of the world, there's no spread, right? So in Europe, zero interest rates or negative interest rates. So there's no value in having money in the bank if you're a banker, or very little. So, that for us, to give you a sense, we make about $75 billion a year. If we had normal interest rates, we'd make $15 billion a year more if it was normal. So, and I don't think it's going to be, I think the new normal is that. So that's not going to come back. So banks have always been a utility, except we didn't realize we were a utility because we made so much money. And so we could afford to do a whole lot of stupid stuff, quite indulgent.
Define stupid. I mean,
look, we'd buy things, we'd merge with, we'd plant flags all over the world, we'd get into other businesses. All that's over. So I think the days of banks doing profligate things are over. And I think you're right, regulation's getting tougher and tougher, so that puts a whole lot of friction into the system for us, if you like, in what we do, but also for our customers as well. So we need to there's really only 3 things we need to do. We need to reduce the amount of capital in our business, which is really boring for all of you, but I need to worry about it. So we need to be much more capital efficient. And then there's 2 things that should be of interest to you. One is we need to have much better frictionless experiences for our customers, because really nobody wants to do banking, right? Except me, right? Banks want to do banking, but our customers don't want to do banking. Our customers want to own a car or own their home or go on holiday or retire. That's what they want to do. Now, we might provide a product or a function that allows them to do that, but they really could do without it. So if we can sort of make that disappear, that would be fantastic. And by the way, the same is true for corporate, right? Corporates don't want loans. They want more stock for their stores, or they want a new piece of equipment, or they want to open a subsidiary in another country. They don't want a term loan. They don't want receivables finance. They don't want foreign exchange. They want something else, and we just happen to facilitate that. So we need to take all of this sort of mumbo-jumbo out of what we do and make it a lot easier. And we've got to make the whole thing way, way, way less expensive. So I have around 50,000 people who work in operations for me, another 25,000 people who work in technology. If we were really any good at what we do, and my vision of what we'll be in 2030 is we, instead of having 50,000 people in operations, we'll have 500. So we want to take 99% of all of that human activity out. If I can do that, that will save about a third of the cost base of the bank, a bit more. So then we will look and feel like a proper utility. So we will be relatively frictionless. It'll be reasonably efficient for our customers. It'll be most things will be almost transparent, and there'll be a lot less human beings doing it because we'll have engineered all the friction out of the system.
Yeah, it makes sense. So following this, this concept that you were describing, it looks like you announced in 2015, $1 billion investment into digital transformation. And early today, here in the chat, that were two guys from the government having a conversation around how to transform the experience for citizens and for communities. They were saying that it's very difficult to measure sometimes the return on investment on some digital initiatives. I would love to see and to understand how you measure those returns, if that's the case, because I heard together with a billion investment, like $5 billion in savings, something like that. How you measure those projects, how you think that the world should see that kind of digital transformation that is so important for everybody.
Like I know you're a romantic, and probably most of your colleagues are romantics. I'm uber rational. Every penny we spend has got to have a massive return on investment. So every penny we spend needs to have a 10 times return on investment. So the digital stuff's not too hard. So for example, just a few things. So this is not going to sound particularly revolutionary, but we've got several million customers on Touch ID on iPhone and the equivalent on Android. It costs us a couple of million, but it gets rid of thousands and thousands of telephone calls out of our telephone center, because instead of calling us on the telephone every day to ask for a balance or to do a transaction, it's much easier for people to use a digital device. We've put biometrics into our telephone center, so instead of you getting through, you listen to an IVR, then we ask you a lot of stupid questions which nobody knows the answer to, like when did you open your account, what was the last transaction, like really stupid questions that really irritate customers and mostly they can't remember. You just go straight through and you start doing stuff. We actually had quite good digital functionality, if you think about like the ability to do things, but it was hard to get to, and sometimes it was hard to use. So simple stuff like you had to scroll down from one screen to the next, you need to move your thumb to get it from one piece of the screen to another piece of the screen to do one thing. So a whole bunch of things that just made it a pain in the ass for customers to do it. And look, financial services, unfortunately, it's not like Disney or some of your more exciting customers. It's a really low involvement category. Nobody's really bothered about banking. They don't want to put any effort in. So we've just got to make it super duper easy. If we make it easy, they'll do the easiest thing. So it's not about being sexy or exciting, I don't think particularly. It's about just making it super easy, totally frictionless. Then they will follow the path of least resistance and do it the easiest way for them. The easiest way for them is almost certainly the cheapest way for me. And I'll save a whole bunch of what I talk about as failure demand. So all those telephone calls that we get every day, most of them should never happen. If digital was easy, they wouldn't phone. If we didn't send stupid bits of paper to them through the post, they wouldn't phone. If we didn't stop them from doing perfectly logical things like sending more than 10,000 in a single transaction, they wouldn't phone. If they want to set up a new beneficiary for a payment, they wouldn't phone. And I can go on and on. There's just a whole lot of things that we have built into. Sometimes it's regulation, sometimes it's compliance, sometimes it's legal. Mostly it's not true. But allegedly, compliance won't let you, legal won't let you, the regulator won't let you. And if you can take all those things away, people will just do what's easy. and we can save a huge amount of time and effort, and our customers love it. So it's a perfect win-win. They think it's better, it's much cheaper, it's much easier, and it's mostly straight-through processing. So we are going to spend $1 billion and save about $5 billion through the digital stuff. So it's a 5-to-1 return investment. The reason it's not 10, which is what I'd really like to be, is there's a bunch of stuff that unfortunately we built before that we're really having to build again, because it was sort of kind of good, but not kind of good enough. So we have a bit of re-engineering of our old digital, not because the functions weren't there, but because it was not easy to use.
I still need to understand, why, I will talk as an individual, banking with my bank. I have my personal accounts, and then, I have my corporate profile together with Globant, and then I have another profile, which is, my investment banking profile. And then I have all the investment bankers that are dealing with the IPO, whatever. They insist in treating me like 4 different persons. Well, why?
You are. No, you have.
No, I am.
You have
I
multiple.
have 4 personalities.
You have, but you do have. You should know this. You have multiple personas, but it is hard for our customers to understand that you as an individual is a different persona as you as a beneficial owner of a company. Is it different from you as a controller of a company?
I totally get it.
But it's really irritating. I totally understand how irritating it is, but it is true that legally and from a compliance point of view and a regulatory point of view, you have different personas, and we've done an absolutely rubbish job of doing 2 things. One is explaining it in the first place, but then also not making it as bloody painful as we do, right? So we make it, we make you start again, right? It's like, I think it's quite similar to your experience with government, right? So you're one sort of person for your benefits. Then you go for healthcare, so whether it's hospital or doctor, and it's like you never existed, like for unemployment benefits or anything over here. Then you go to the dentist, you're an entirely different person. Then you go to the vehicle registration for your car, and you're a different person. And there's no join up at all. There's no transference of data, and sometimes it's driven by privacy, but mostly it's just crap engineering. And really poor customer experience. So we need to get better at the engineering and better at the data transference, but also explain it where sometimes you can't get around doing something over again. But that should be like this tiny much, not all of it again.
Yeah, but I have like 4 users. I have like 1 user for private, 1 user for internet, corporate banking. It's difficult to understand. So that the technical solution is not very complicated indeed if you think it from the scratch. So I may guess that there's a huge fight again within banks and organizations, in general, big corporations, between those simple solutions that can be done and whatever the status quo is within technology, all right, which is normally known as spaghetti, and I don't know how you call it, but we normally hear many times talking about spaghetti,
yeah.
like, referring to the central pieces of the core banking. So how you fight that battle? How you manage to figure out to overcome those situations? It was firing people, it was, threatening people. That's how you did it.
So it's funny, you're asking me tough questions in a funny way. My day job is asking everybody else tough questions, which is, why do we have to do it like this? Why do we have to do that? Who said? Which rule? Where did that come from? Show me what the regulator said. Take me to see the regulator. Bring me the head of legal. Bring me the head of compliance. You can break, if you keep pushing at it, you can find, actually it's very rarely technologically difficult. And if there are real impediments, they tend to be real legal impediments. So the best example, I think you all know we have a fantastic business in Hong Kong. It drives our Hong Kong entrepreneur clients absolutely crazy that their private wealth and their business are so segregated. And there is actually nothing we can do about that. That is determined by the Hong Kong Monetary Authority. What we did a terrible job of was helping two things. Helping them understand what was different and why, and how that gave them protection from a legal perspective, and why it was important. And actually, one of my these things come down to actually quite human things. So the new head of our commercial bank there has been doing seminars with our wealthy entrepreneurial clients and showing them the risks of not segregating their personal and their business affairs and what can go terribly, terribly wrong. That's not an excuse for making it really difficult and hard, but it's being able to explain at a human level what needs to be different and why. That wouldn't have worked if we hadn't been able to make it both parts of their lives so much better by implementing new technology, so as both things got much, much, much easier. So when you've made it easier, you can then explain the real differences. If you try and explain the differences when it's still very hard, it just sounds like excuses. So to me, it's the equivalent of, I'm perfectly fine with flying on cheap airlines, Southwest or Ryanair or EasyJet. And I love Singapore Airlines and Cathay, because they both do exactly what you'd expect. One gives you a really simple experience with no frills, and you get really good value for money, and the other one's quite a luxurious experience. But what really pisses me off is when you get on an American airline or British Airways or Air France, which purports to be like Singapore or Cathay or something like that, but actually feels like Southwest or EasyJet or some other sort of budget airline. And it's all about really understanding the customer experience hierarchy, which is, if you don't get those hygiene things right, there's no amount of explaining or fluff or marketing that's ever going to make it better. If you can get the stuff that really matters to customers right at that bottom of that, Maslow's pyramid, if that works, then you can go up. But if you don't get this bit right, it'll never work. And for too long, banks have never really focused on getting that stuff right at the bottom of the pyramid. So we are putting a huge amount of effort to actually just what I would describe as getting the basics right, taking all of the crap away. And then you can go and do something that's interesting and feels good. Or you have an opportunity to explain why something that looks bonkers or crazy is actually something that can't be avoided, and there's nothing anybody can do about it. But it's only when you get to that point you can ever get away with explaining it, because otherwise it just looks like you're making a horrible excuse for a shit service. And for too long we've been making excuses for shit service, so we can't do it anymore.
It looks like we're facing some kind of new kind of customers. I watched a video that an interview that was made to you in 2014 around that the banking industry was all placed around men experience, banks for men. And at some point you discover that women had a lot to say about banking, and you need to make a transformation at that time for making the bank more appealing to women. It looks now that a new kind of customers are arriving. Would you make a parallel between those new millennials that are coming and that change that you did in the past?
Yeah, so I've quite a controversial view about this, because I've seen this a couple of times. So I actually was looking at some data yesterday. So in 2030, in this country, so in the United States of America, the baby boomers will still have more money than every other segment by demographics. And three years after that, the millennials will have the most money, and Generation Y will only have 3 years in the sun, just 3 years. So at one level, you can get very excited about building something for 14 years' time for the millennials. But in the meantime, the money's with the baby boomers.
Yeah.
So that's what really matters. I'm afraid I'm like Willie Sutton. So Willie Sutton was the guy who coined the phrase, like, why do you rob banks? Well, it's where the money is. Like, I'm interested in the people who've got the money because they're the people who are profitable. So I'm very focused on what in the US you would call baby boomers. The other thing is, as people get older, they get more like old people. I know it's a brilliant insight.
Oh, it's amazing.
But this idea, and look, I used to work in consulting, and some of my bright young things would come up and explain to me that then in 10 years' time everybody would be like the young people of today. And actually, I said, no, actually, in 10 years' time, the people will be 10 years older and they'll look like people who are 10 years older. And that's always been the case. So I genuinely don't think there will be as big a change as we believe there will be. Because there hasn't been in the past, and I actually don't really see any reason why it's going to be different. So I spent the last 2 days with some old people who've got a lot of money, angel investors and hedge fund folks, and a lot of young people spending it, fintechs. And so the fintechs are all busy explaining why, their thing's going to be great. And the response actually from the people with the money who are investing in them, not using their products, was, okay, but as your customers get older and their lives get more complicated, how do these things work? To which their answer was, well, it doesn't really matter. To which the people with the money said, yeah, it does, because I'm not investing in it unless, as those people get older, they're still going to use it. And one of the examples which I thought was most biting, so I will save their blushes. I think that it's a fantastic piece of technology for consumer lending. It works here in the US. And this question was really, really simple, which is, if this is so clever, how would it deal with a customer who had a personal loan, a credit card, and an overdraft? And the response was, customers really shouldn't have those three products. To which the response was, well, unfortunately, customers do have those three products, and they're not going to just have one product, because the way humans think about those things is, an overdraft is something that you have for an emergency. It satisfies a different need. A personal loan is typically for a car or a holiday or something else. It's a purchase that you pay off. And then the credit card is used for a holiday, an experience, whatever. And if you think you're going to change the way humans think about money, which tends to be in sort of jam jars, and your technology is going to change how they interact emotionally about their needs, you're dead wrong. And so this guy had a really tough time from these investors, and he didn't get any money because he was so focused on the technology and the fact that this was a cleverer thing. He had no understanding of how humans think and behave, because as far as he was concerned, it was all the one need. He had no understanding of the emotional human need. And I think that as people get older, life gets more complicated. So you want to own your own home, you have children, you have illness in your family, and suddenly you need a lot of things that are not as straightforward, and you have a lot of trade-offs to make. And that's where these wonderful monoline, clever bits of technology stop working, and you need to glue it all together again. And actually the hard bit isn't the individual products, and so everybody thinks the product stuff or the interface stuff is, but the hard bit is gluing it all together. And the piece of technology that's best at gluing that all together is something quite like you. It's called a person. And as people get older, as millennials get older, they will find that they want to talk to a person about complicated things where actually it's not a simple matter of logic, and it's not a matter of artificial intelligence and telling people what to do, no matter how clever the logic is, isn't the answer. That actually having a conversation is what you want to do, and it's hard to have a conversation with a piece of logic. So I think millennials will look like older people when they get older. and it won't be. No, they'll obviously be different, but it won't be as different as we
But
think.
Andy, hold on. You're saying that MyLinear doesn't exist?
Of course they exist, but they don't have any money. So I don't care.
Okay.
When they've got money, then I'm interested.
Okay, but those MyLinears are the ones that are using the fintech companies, the fintech companies. So
Yeah.
tell me your perspective on how you see the fintech environment going. Do you see that there's future there? Would you buy them?
Never. Never. We'll never buy them. If we bought them, we'd destroy them. Most of them actually are where they are interesting and good, and there are many that are interesting and good. They're interesting and good because they serve multiple things, multiple institutions. I was going to say multiple banks, but it doesn't have to be multiple banks even. There are things that go across. And so actually, I imagine that so two things will happen. An organization like mine is probably the best way for a fintech company to make $1 billion because we have 50 million customers, we operate in 71 countries. We can quickly help them monetize a really good idea. So it's much better for me to collaborate with them, to partner with them. For most of the things, if I owned it, I'd destroy it. So I'll give you a couple of examples. So we do quite a lot of blockchain work with a company called Ripple, based just down the road.
Yeah.
If I bought 20% of Ripple, if I bought 100% of it, nobody else would use it, and then it's worth nothing. So that would be stupid. If I bought 20% of it, only 5 other people could own 20% of it. But actually, to do what Ripple does, so Ripple's blockchain technology is most likely to go big in high-value payment settlement, cross-border. Well, there is about 20 of us who essentially make up about 85% of that market. So the ideal exit for Ripple, I think, is for 20 of us to own 5% and to use it as a common good. It will become a de facto standard for the global industry. They will become very wealthy, which I have no problem with at all. And we will get some return on our investment because we will have 1/20 of that. But until we transform our technology organization, if we bought a fintech and took it in 100%, we'd just kill it. Somebody coined the phrase this morning, banks are a place where fintechs should go to die. And I think that's probably true. If you actually buy fintechs, you'll kill them. So I don't think banks are good owners of fintechs. And I think a lot of fintechs will disappear because they think they've got something super clever, but it's too narrow. And people just cannot be bothered gluing together a whole bunch of things. You know, if you wanted to make HSBC with fintechs, you need 147 of them. 147 of them. If you want. Now, arguably, nobody would want to be us, so I get that. Sometimes I'm not sure I want to be us, but nobody's going to glue 147 of them together to create what we are. And most of them solve such a small part of an individual customer or a commercial customer or a investment banking customer's needs. I just can't be bothered. We were talking, when we were waiting, there's a fantastic company called TransferWise. TransferWise do, I think, the best, least expensive, frictionless foreign exchange trading for individuals. So it's brilliant. Absolutely brilliant. But I don't want to own it, because if I owned it and I had it available, most of my customers don't want to do high frequency, very low cost FX trades. If I offered it to my customers who do, I have to offer it to all of my customers who don't. That would cost me billions of dollars a year. So I'd buy a company for a small minority of my customers. I'd have to offer it to all of my customers, destroy the profitability of a business I've got. Like, it doesn't make any sense. And for the number of customers who will use them, not us, I lose almost nothing. And nobody's going to leave me as a bank because of TransferWise, because TransferWise don't do the rest of what I do. It is also true that most of those customers who will use TransferWise won't leave any other bank for any one of those very narrow verticals. And if that sounds, I don't mean this to sound like everything's going to be fine and big banks are going to be okay, because I don't think that's true. I think the really good fintechs will pull little pieces out of us, and we could crumble, but we're not going to crumble because somebody comes along and builds a better big bank. The danger is little by little, segment by segment, product by product, we get pulled apart. So I'm very worried about that. But that to me is very different than one individual fintech capturing the heart and soul of my customer, because I haven't seen a fintech that comes close to capturing the big toe of one of my customers. So it's a very awkward problem, because ideally what I do is I would identify the couple of hundred that are really a threat to each part. I would buy a piece of each of them on an each-way bet that if we feel as we are today, my bets on all of those succeeding will balance it out. And it's really hard to get your head around. So it's not going to be easy, and it's going to be a big threat, but I can't see fintechs winning my customer. I can see wintechs winning parts of my customers bit by bit, and actually in a funny way that's harder to compete against. So I'm quite worried about that. So that's what bothers me.
It makes sense. So my last question, I think we're running out of time here. I don't know if you have time for some questions for the audience. Okay, but my last question is, so you see a pretty, clear situation, although those threats that you are seeing now. So where's your Uber? Where is your Uber?
Yeah. I don't think anybody wants an Uber bank in that sense, right? So Uber solves a problem that didn't need to exist. So it started here. And why did it start here? Two reasons. One, there weren't enough taxis. And two, the regulation of taxis was so terrible that the taxi drivers hid behind it. We're not exactly short of banks. And we're doing our best not to hide behind it. And I don't just mean we, HSBC, I think banks in general. And what I see happening in most markets is regulation is, if you like, the equivalent of Uber. The regulators are, or the bits of Uber in banking. Regulators are starting to get really, really worried about it, and they're starting to clamp down on that, because it's one thing hitching a ride or a whole bunch of other things that happen that don't really matter, but when it's people's money. So the scenario we talked about this morning, so you think about a peer-to-peer lending company. The first time that somebody defaults and it has an impact, a collector with a baseball bat and a leather jacket goes around to collect the money. And you get them up in front of Elizabeth Warren here in the United States in front of Congress. Like, that's your Uber moment. So it's a different thing, and it doesn't mean that we shouldn't be trying to make things really easy and simple. But you can't have an Uber moment in a heavily regulated industry, because until you take all those things away, there's nothing I would love more than to have a universal product which provides variable positive interest and all types of debit, so the equivalent of a credit card and a personal loan and an overdraft all at once. But you can't go create that if the legislation and the regulation doesn't allow it. And in fact, people have invented it. The guy who invented Visa in 1956 had a dream, and his dream was not Visa. His dream was a single card which would do everything. It would be a deposit account, a current account, a credit card, a personal loan, and a mortgage. That was his dream. And he left Visa halfway through its wonderful success because he knew his dream would never become a reality. Because the banks, as he would describe it, the banks stole his dream, quote unquote, and then the regulators kept his dream from ever coming to place. Because regulators regulate cards separate from mortgages, separate from loans. And there's nothing I can do about that. I would like to change that. In fact, I worked for a company who created the dream that the guy who invented Visa wanted to do. So it was a mortgage and a current account and a card. And in fact, you didn't even know any of that existed. It was a universal product that did everything. The problem was only 1% of the market wanted it. It was incredibly successful with 1% of the market, but it never took off. And the same thing has been designed and developed in a number of jurisdictions, but little by little, regulation has killed it. So I can't, to my horror and disappointment, I can't see Uber in banking because of the regulation. If we could break down the barriers in those products and let people's needs be fulfilled by one thing, multiple needs be fulfilled by one thing, then we could do it. But until we can break that paradigm, and I can't see any, because the belief in most governments and most regulators is if they let banks break that paradigm, that we would take advantage of our customers. And until banks or something like banks restore the faith of not only customers but society that we can be trusted, we'll never be able to roll back that legislation and regulation. And until the legislation and regulation change, we can't have the Uber moment. So I find myself quite depressed saying it.
But don't you think that at some point regulators will be us? I mean, will be other people that will think it differently?
No, because look, the politics of this are really, really simple. There's everything to be gained by putting us in the dock, literally in the dock, for, so if you get charged too much on your credit card, the bank's to blame. If you default on your home loan, the bank's to blame. And I don't expect any sympathy, right? The industry did many bad things. Politically, not just in this country, but most countries, what you have to do is you have to take your hand off the throat of the financial system. And politically, I think that's impossible. I don't think anybody's going to be brave enough to let go because they fear the beast. And they're probably right to. If you look at our track record, they're probably right to fear the beast. So unfortunately, you can't let go to get to a better place. I think, sadly, at least not in my lifetime. I'd like to think you could. I mean, technically, it's easy. There's no reason why you wouldn't do it. But you have to let go of all those individual pieces of control and protect. Because it's consumers, right? The whole banking system is regulated to protect consumers' deposits. Because ultimately, the government stand behind the banking system and guarantee deposits. To do that, they have to control the other side of the balance sheet, which is all of the lending. If you let go of if you don't hold my throat on lending, I can lose your deposits. And that means I lose an election. And for a politician, I will never do anything that makes me lose an election. So if it sounds depressing, I'm sorry, but that's the thing that needs to be unlocked. I wish we could, but I don't see it happening in my lifetime. I mean, not just in my career, but like if I live to 100, I don't see it happening.
Let's call it democracy.
Well, it is. That's the problem. It really it is simple as that, which is millions of people feel uncomfortable about it. So.
Thank you, Andy. Let's open up for a couple of questions. Just one question, and we run out of time. Wow.
Very fascinating. And I was just curious, disruption, it sounds like you're saying, erodes, the appetite for disruption erodes over time. So what if that doesn't happen? What are there levels of disruption that you think that will be, that will sustain over 10 years when the millennials get to be 30 and have the less appetite for disruption, or 40 and so on and so forth? Will they not be kind of forced in the mentality to maybe make some mild disruptions, or do you see that just maintaining more of the status quo?
Yeah, and I don't think it's a status quo. So I want to be. I think that my Malthusian version of this is constant erosion, if you like, of the traditional banking business, and that's the scariest thing, because if you could make a bet on a different future, then that's something actually I could cope with. But constant erosion from every direction is very hard to manage from a business point of view. The reason that probably incumbents don't end up being blown up, and you could argue they should be, is actually people just don't care enough about financial services. They really don't. People care more. In marketing speak, it's a low involvement category. People care more about their tennis shoes or which grocery store they go to than which bank. They really don't care enough. So that I think is the thing that will hamper it more than anything else. You just won't get enough enthusiasm. The closest anybody's got to it actually was a bank here in the US, Commerce Bank, which Toronto Dominion ended up buying. And their mantra, they wrote a book about it, which is, fans, not customers. And they massive growth, did wonderfully well. Actually, a very traditional model, branch-based, and that's got nothing to do with it. It was everything about the customer. You needed two people to say no, one person to say, and it was everything that you guys would think is absolutely right. It's what millennials would espouse. Everybody adored it. But again, it had narrow appeal because it wasn't enough. By the way, the same guy has started almost the same thing in the UK. He's doing very successfully. He'll make another $1 billion or $2 billion. It's exactly the same recipe. It appeals to the same people, but it's a narrow segment. It doesn't have. There's just not enough people who give a shit about it. We have a brand in the UK called First Direct. It was the first telephone-only bank. It never had any branches. It appealed to the millennials of their time, so Gen Y. Did brilliantly. We got 2 million customers in no time flat. We haven't had a single new customer since then because it captured the segment that it wanted. Now, and one of the reasons I'm quite confident about, the next generation being quite like the last generation is, do you know what the average age of our First Direct customer base in the UK is? 57. So it was late 20s, early 30s, professionals, go-getters who didn't want branches, totally non-traditional, happy to do everything on the telephone and through, dial-up modems on the internet, last time around. And they were going to be different. They look quite like me. In fact, they look very like me. Slightly fatter, obviously, but mostly like me. And they have just got older, and they have changed in their wants and needs and all the rest. So it all sounds a bit dull, doesn't it?
Thank you very much, Andy. Great chat. Thank you very much.
Thank you.